This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Hello, this is Hall Martin with Investor Connect. Today we're here with Angela Lee of 37 Angels. Angela, thank you for joining us.
Paul, thanks so much for having me.
Great. So what was your background before investing in early stage companies? What did you do before this?
Yeah, so I'm a founder turned investor. I started my first company in the dot-com boom I was in California. It was a very different time. And so that was kind of my first love of entrepreneurship. Started a couple companies along the way and started angel investing in 2008. Excellent time to be investing. Professionally, I started my career as a product manager, then moved on to management consulting at McKinsey. And then these days, I am a professor at Columbia Business School where I teach primarily venture capital courses, but I also teach leadership and strategy courses.
Well, great. So what excites you right now?
Oh my goodness, founders. I mean, I think something that it's important to be as an investor is someone who just loves talking to founders. And every day I wake up and get to talk to really passionate people who want to change the world. And that optimism is infectious. And I think it keeps me young. It keeps me excited. And so there's nothing I love more than talking to founders.
That's great. So let's talk about the state of investing for angels and venture capital. How do you see the industry evolving and what changes do you see coming up for those two groups?
So it's an interesting time to be asking that question, right? So, I would say if you're asking this at the beginning of 2020, we would have been talking about how frothy the market is and how in 2019, 600 new seed stage venture capital funds were started. And that, we were on the brink of bubble bursting, all that kind of stuff, right? Talking in the beginning of April, in the middle of kind of the COVID-19 crisis, it's a very different time. So I think the question right now is, are we looking right now at a short-term blip or a more sustained economic downturn? I think the good news for startup investors is that we lag public markets. And so we'll see what's coming. That's one good thing. I think the other good thing is there are still a ton of really interesting sectors to be investing in, right? Health tech is doing great. Future of work is doing really great. Ed tech is doing really great. And so from a sector perspective, those are three sectors I'm really excited about today.
Well, great. So we'll see how she comes out with this current stock market volatility. What do you think the current investment position is on it right now? How are people reacting to the COVID-19?
Well, so let's kind of take angels and VC separately. I think from an angel perspective, I'm part of a group called New York Angel Alliance. There's about 30 angel networks in New York City. About 20 of us get together every month or so. And we talk about kind of the state of the angel network. How can we help founders? We met about a week ago, and I just did a really quick poll and asked kind of who is business as usual, who is slowing down investing, and who is completely pausing on operations in the short term. And it was about 70, 20, 10. So 70% of us completely business as usual, still writing checks. For example, 37 Angels, we closed a investment in a week. 20%, they're slowing down. They're saying, okay, we're going to take fewer pitches. We're going to write fewer checks. We're kind of going to wait it out and just go a little bit slower. And then about 10% said, we're fully pausing until we know what is happening, until we come out the other side. We're not writing a single check. So that's on the angel side. And my guess is that's kind of reflected across the country and across the world because a lot of us are investing our personal assets. They have taken a hit from a net worth perspective. I think on the VC side, I actually think things are a little bit rosier. And the nice thing about venture capital, it's very long term. People have raised funds and they have to deploy them in 3, 4, and 5 years. And so while I think the next 3 months are going to look a little bit slow, my hope is that by kind of Q3, that we're kind of back in the natural swing of things, of people being a little bit more cautious on valuation. So I think valuation is going to drop, but I'm hoping that the level of activity will be maintained kind of 3 months from now.
And how much do you think valuations are going to come down in this? Is it equivalent to the stock market or is it more or less?
I think that if you look at like valuations, again, end of 2019, early 2020, seed stage was averaging, depending on where you are, I would say that most of us would have said that seed stage was overvalued by about 30%. And so I do think that valuations are going to come down 20 to 30%. They have to, because things were just getting ridiculous, right? A company that has very little traction, first-time founder, was able to get funding at a $10 million pre-money valuation because there was so much money in the ecosystem. And so I think that will correct. It's for a terrible reason, but I think it's the right thing to happen in the market.
Right. Good advice and good insight on that. So let's talk about your group and your investment thesis. What is it for 37 Angels and your work?
Yeah, so we are 80 investors based in New York City, and we are fairly sector agnostic, although we invest a lot in health tech, logistics tech, future of work, and a decent amount of CPG. We were, I think, lucky that we're investing in a lot of industries that are still incredibly strong, even, in April of 2020. So that's good. But I would say our investment thesis is really around the fundamentals. So we look at things across the 4 Ps: people, problem, progress, and price. And we are primarily people investors. So we always say we are investing in rock star teams in really attractive markets. And so that is primarily what we're looking at: people and the problem that they're trying to solve.
Great. And can you talk about 1 or 2 startups that you've funded that fit your thesis?
Yeah, I think a startup that I'm incredibly proud of right now is called Kinsa Health, Kinsa. And this was started by Inder Singh. He was very senior at the Clinton Global Health Initiative, and he created a digital thermometer. Doesn't seem particularly innovative, but what's really innovative is that this digital thermometer was paired with artificial intelligence to really do prediction around what's happening in your neighborhood around health. So if your kid wakes up and they have a sore throat and a fever, you can actually look at this just like a weather map. You call it a health weather map, and basically start to predict, does my kid have a cold or do they have strep? And what's really amazing is 2 years ago, the CDC actually worked with them to figure out where to put the flu vaccine, because I don't know if you remember, the flu was terrible a couple of years ago. People were dying from it, and there wasn't enough flu vaccine to go around. As you can imagine, given what's happening right now, it's particularly interesting. They were just in the New York Times. Rachel Maddow just did a big piece about them because they are able to really predict the spread of the coronavirus. So, and on top of that, we invested in them in the seed round. They raised an A and a B led by Kleiner Perkins. And so it's really nice when a portfolio company is both doing well, but also really doing a lot of good in the world and saving lives.
Sound like a great portfolio company. So let's talk about the challenges for the startup and investor today. Let's start with the startup. What do you think the main challenge your startups face that you see you're working with?
So I think a more perennial problem around startups is that there's so much stuff, there's so much noise to kind of sift through. And so as a founder, it's really hard to know what event should I go to, what conference is going to be useful to make those right connections, who are the right investors to be talking to. And there's just a tremendous amount of noise to filter through. And so I think the job of a founder, especially the CEO and the fundraiser, is much harder than it was before because there's just a lot to sift through. And there are so many tugs in the time. And my goodness, the FOMO is real. So I think that's one big challenge. I think the second thing is because there are so many investors that are new, there's a lot of education in both directions. And I think for founders to know who the right partners are to work with is really, really challenging. And so that is what I would say as a founder these days. And then the last thing I'll say about founders is that the bar for every stage keeps going up, right? And so the great thing about being a founder today is you can build a website for, $4. Whereas when I started a company in 1999, I think we spent like $20,000 to build our website. But the bad news is that even seed and pre-seed investors, we expect a lot from you, even if we're the very first money in. So gone are the days of investing on the back of an envelope. And the bar is really high for founders. And I think you hear this a lot, like, oh my goodness, I can't believe that for a seed stage check, you need me to have how much in revenue and how many customers. And it's because so much can be done with so little, and there's so many tools out there. And so I think that bar can be a hard one to get over.
Yeah, the cost of starting a business continues to fall dramatically. And so that should be translating into better results or faster results. And that can be challenging for the startup.
Absolutely.
And then, so on the investor side, you deal with a lot of investors. What's the challenge they face in going after these startups and working with them and funding them and supporting them?
Yeah. So I think the first thing is just the sheer volume of stuff out there, right? So we look at 2,500 companies a year and invest in 10. That is just a lot of companies to talk to. And I would say most professional investors that I talk to, that is the volume of deal flow. And the earlier you go, the more and more companies you're talking to. So I think that it's just a very different business, just in terms of like the sheer administration and management of all of that. That's one. The second thing is again, until recently, it was really, really competitive. And so there's kind of a couple ways to compete as an investor. One is brand, right? So if you're Sequoia, Kleiner, that's great. The second is valuation, which is why valuations have been creeping up. And then the third is value add. And so you see all of these VCs building these platform services where post investment, we're going to help you with marketing or with HR or with branding. And that's really, really expensive and frankly hard to do well, right? Because VCs are good investors, hopefully, but for them to also have an HR function so that their portfolio companies don't have to think about HR, it is diluting what it means to be a venture capitalist. So I think that is hard to figure out as a VC, what value add services should you add to be competitive so that you don't necessarily have to compete on valuation, which is bad for everybody.
So how do you manage the deal flow process for 2,500 deals?
So I think a couple things, right? One, I do think that the good news for the junior people who are coming into the investing ecosystem is that you have more autonomy. So we have investment associates like any other firm, and they are autonomously looking at the deal flow and saying, of the 2,500, who are the 500 every year that we're going to take meetings with? And only at that point does the investment director get involved, or the partners. And so I think a lot of that decision making has been pushed down to more junior people, which again I think is a great learning opportunity for the junior people. And I would say that's the same at a venture capital firm, right? The associates are doing a lot of autonomous decision making, because the partners can't look at that deal flow. So they rely on the associates to be that initial filter. I think that's one way. And then also there are technology tools cropping up to make it easier for investors to share diligence data, both within a firm and across firms. And so there are those technology tools that are growing. I will say this though, I am shocked at how much stuff still gets done via email, via Google Docs, and maybe an Airtable. I don't think there's a perfect system yet.
Great. Well, it sounds like another opportunity for a startup to come in and solve that problem. So we'll be looking for them on our deal flow pipeline for sure. So you see a lot of different startups. If you had to pick out one or two sectors or applications you think are good immediate opportunities today for investors to pursue, what would you choose and why?
Today, it would definitely be future of work. And again, that's been my own personal investment thesis for several years now. So there are kind of two areas within future of work. One is supporting the remote worker, right? In the US, I think 40% of workers are not W-2'd. They're part-time, they're digital nomads, they're working on a beach in Dubai, whatever the case may be. And so how do you support that worker, both in terms of distributed work tools, but also retirement planning, mental health resources for people who feel a little bit lonely and isolated, whatever the case would be? There's a ton there around future of work. And then the second area of future of work is work automation, right? So our robot overlords, replacing us as workers and investing in that. So I'm much more in the first space. And again, the reason why we believe in that thesis and investing in that space is because we are changing jobs more and more frequently. When I graduated from college, the statistic is that on average, we'd have 5 careers. These days, it's 9 to 11. And so what happens is that people are changing jobs more and more, so they need to fill in that skill set gap. But also, certification, that cycle is faster and faster. And so skills are becoming obsolete more quickly. So what that means is that the adult learner, that need for upskilling is dramatically increasing. And so that market is exploding. Obviously, given my background in education, I'm passionate about education as well. So that's an investment thesis that I think both make sense because of macro trends, and it happens to be one that I have expertise in.
So how much do you think that COVID-19 is accelerating that shift to online work, remote work, and those new automation tools? I mean, 6 months ago, robotics and AI were coming to take our jobs, and today it's now becoming a necessity to have basic services put in place no matter what happens to the people in quarantine. How much do you think is going to accelerate from COVID-19?
So I think I think what it's going to do is it's going to force a lot of innovation in the area. And I think that a good amount of that innovation will remain even after the pandemic is over, right? So I think a lot of firms next year, especially if we're in a little bit of a tighter economy, travel budgets are going to be slashed because people are now realizing how much we can get done on Zoom, right? And so that is here to stay, right? But I'm sure a lot of us are having Zoom fatigue, and it's exhausting to kind of sit in that way. So there will be startups that are going to crop up to make online meetings more effective, right? That's just one very small example. And then on top of that, how do you think about connecting people and doing socializing? I mean, the number of people who are like playing games online. I just played Pictionary this past weekend online with people. Like that whole area is exploding. So I think what it's going to do is it's forcing innovation. And I think, not to throw a percentage on there, like a third of the like forced innovation that is happening right now is going to stay well beyond the pandemic. So I think it is definitely a macro trend that is here to stay. And I feel very lucky that it's a space that I've been investing in for years.
I think you're certainly well positioned in this economy, and even afterwards, we'll go back to some of the old ways, but I don't think we'll go all the way back to the same level of travel and face-to-face meetings as we did before. I think there's some cost savings there. Any sense as to how much it will go back versus carry on?
Yeah, I mean, my guess is that if you just think about if we just look at travel budgets, for example, I think that right now there's a lot of no questions asked, right? Like we all make our travel budgets and the default is kind of like you get to go until you hit some sort of cap for the year. And I think that what will happen is it'll be much more like you have to justify the travel versus it being kind of a knee-jerk, sure, of course you can go. And so I think that's going to really change things, right? Again, in academia, we do PhD seminars all the time and people go all over the world and they present at a conference. That doesn't necessarily need to happen, but what happens at conferences, there's all this amazing networking on the side. And so I think startups are going to crop up to say, okay, the plenary part of the conference can happen using existing tools, but how do I really allow people to have those connections in the hallway, at the buffet line? Like, how do we recreate that when we're all sitting kind of in our living rooms?
Well, that's good input. So let's talk about your advice. For those that are investing in startups, what do you tell them to do before they start to invest in startups and write that first check?
The main thing I tell every kind of new and aspiring investor to do is to hear 50 pitches. And hear 50 pitches, but don't hear them in a passive way. Go to those demo days, go to those pitchathons, go to those hackathons, hear pitches, and then bring a little notebook with you. And then force yourself to say, okay, what do I think about the team? What do I think about the market? What do I think about the product? And would I take a meeting with them? Would I invest? And on the rating of the team, the market, and the product, force yourself to do a scale from 1 to 4. The reason why you don't want to do a scale from 1 to 5 is because it's very easy then to pick 3. But a scale from 1 to 4 forces you to kind of pick a side. And then, would I take a meeting? Would I invest? And then every 3 to 6 months, go on a Crunchbase and see, were those companies funded? The great news is whether or not companies get funding is public information. It's on Crunchbase. You need to log in, but it's a free account. And it starts to get you to develop your gut. And then you might see, hey, this one venture capital firm, they keep investing in things that I'm really interested in. Maybe I should have a conversation with them. And it forces you to really develop your gut versus passively listening to 50 pitches, which I don't think helps you that much. So that's the first thing. Listen to 50 pitches, force yourself to have a perspective. And then the second thing is I would say write an investment thesis, right? An investment thesis is maybe it's a 10-point PowerPoint deck on, if I had a $50 million fund, how would I invest it? And you might say, I'm going to invest at the intersection of augmented reality and ed tech. Why? Because of these 3 macro trends. Here are 3 startups that I'm particularly interested in. Here is the ecosystem in that space. Who are the angels? Who are the VCs? Who are the accelerators? Who are the acquirers? And really force yourself to get smart on an industry. First of all, it's a great calling card if you are interviewing with a venture capital firm, but it really forces you to learn in a disciplined way versus we all passively read 1,000 articles a day. You're not really forcing your brain to chew on that information. And so I think that writing an investment thesis really forces you to chew on the information and figure out something on the other end of a real perspective.
So great. And on the other side of that table, what do you tell startups to do before they launch that business and ask for funding?
So I'd say before you ask for funding, I'm a big believer in data-backed learners. And so something that we always do with founders is it's less that we care about how many customers you have or how much revenue you have. It's that we want to know that you have customer data and you deeply understand your numbers. So if you have a number that says, however many customers, I'm always going to ask, what's your churn? And your response should be 8%. It shouldn't be, I don't know. Okay, so it's 8%. What are the top 3 reasons why customers are churning? You should know that. What are you doing to reduce churn? And you should, maybe it's okay if you're like, we're doing nothing right now, but once we get funding, we're going to add this feature. We're going to, blah, 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 blah. Or your sales funnel. How long does that take you? When are people dropping out of your sales funnel? Maybe you have a UI and you need to fix one step of it, whatever the case may be. But I think like really understanding your data at a deep level and always trying to improve your metrics is something that we really, really look for on the founder side. And then the only other thing I would say about that is to be very precise about asking for help. I literally get asked to go to coffee 10 times a week. I can't have that much coffee. And I always say, like, tell me what you need help with. Be really specific in your ask, because that way it makes it so much easier for people to help you.
That's great advice. I appreciate that. In the last few minutes that we have here, what else should we cover that we haven't?
For folks who are looking to learn about angel investing, 37 Angels has an investing bootcamp where we teach you how to be an investor, and people take it into venture capital to become an angel investor. We have it both in person, obviously not in the short term, but we also have an online version. And so that's at 37angels.com/bootcamp. That would be one thing. And then I always like to recommend books. So a book for founders is called Traction by Gabriel Weinberg. It is all about customer acquisition. So he walks you through the 19 different customer acquisition channels and really gives you like a handbook of how to apply each one. And on the investor side, I would say Venture Deals by Brad Feld. It's a great read.
Great. Well, those are good resources. We'll put those in the show notes. I want to thank you for joining us today. How best for listeners to get back in touch with you?
We're at 37angels.com, and our Twitter handle is at 37angelsNY for New York.
Great. I'll put that in the show notes as well. Thank you for joining, and looking forward to our next discussion.
Thank you so much for having me.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org.
Alti Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.